Everyone, welcome to C-Suite Talks. We speak with industry leaders, introducing you to some of the most interesting people and businesses today. We're focused on women, money, and power, as well as diversity in all areas. Welcome to C-Suite Talks. I'm Beth Hilbing, co-CEO of C-Suite, along with...
Hi, and I'm Dianne Gubin, co-CEO, along with Beth, and we are delighted today. We are speaking with Lisa Lobue, and Lisa is a seasoned banking professional with 40 years of experience in the banking industry. Currently, she is the Senior Vice President of Business Banking at GBank in Las Vegas, Nevada, and throughout her career, Lisa has held various significant positions that have allowed her to work with small, medium, and large companies and support their growth. What's really interesting is that Lisa has written a series of articles called Arc of Growth, which detail the stages of a company's growth and the critical focus areas that need to be addressed at different inflection points. Her goal is to turn these articles into a book, and we are so delighted to welcome today Lisa Lobue.
Thank you, ladies. Happy to be here.
Yes, great. So Lisa, why don't you tell us a little bit about GBank and how you started GBank and what your focus is there, and what the bank is really interested in expanding and so forth.
Yeah, GBank started as a little bank in Las Vegas. They were started by local business owners. They strictly focused on business. They don't have a big retail arm. And the interesting thing is the local business owners felt like there were no banks in the area that would support the industries in Las Vegas, which are unusual. You know, so we have people on our board that are from Terrible Herbst. We have the head of casinos, MGM, on our board at various times. We've had various industries that would be unique, obviously, to Las Vegas as far as casinos and work. So
Awesome.
So we originally, our massive growth, though, we've been growing 300% every couple years. And a lot of that has been driven by we started in sports betting very early on when sports betting wasn't a thing. And we basically, when you place a bet, you have to have a wagering account, which to us was just like a consumer account. So for a bank, we offloaded all of those accounts, those consumer accounts, for the casinos so that they could get into sports betting, essentially. So we have huge deposits in sports betting, which is highly unusual for a bank.
That's very interesting.
Truly. So is that a big part of your portfolio?
It is not a focus for me. I deal with the commercial, regular business clients, but it's a big part of GBank at the holding company level for sure.
Wonderful. So you've worked with hundreds of companies, various sizes, from small to very large in your current role. What are some of the areas for a younger company as they're growing that you feel that owners need to focus on?
Well, the first thing I would say is they need pristine personal credit. If they had a bad credit history in any way, shape, or form, now's the time to clean it up. Because essentially an investor and a bank is going to look at how you do your personal financing as an indicator of how you're going to run your business. So what you do personally is just as important as how you run your business, especially when you're just getting started. And then I would have to say that there's a huge difference between you want control when you're a small business, but you also need to build out your team. You can't do everything and you're not good at everything. So if you don't build out your team and start to bring in people who are experts in areas that you're not, you're going to very much limit your success.
And typically, what type of financing are these small businesses looking for? And do you deal with diversity as well?
Yeah, typically, if you're under 3 years, you're not going to get a financing from a bank. Usually a bank and even the SBA requires 3 years in business because unfortunately, most companies fail in those first 3 years. So you want to try to bootstrap the company in the first 3 years as best you can with friends and family and angel investors and people that are willing to take a higher risk. You may have to pay them more, but you also need to have that financing in order to get through those first 3 years. And it's okay to pay more, but then as soon as you're successful, you need to, probably refinance and get a regular bank, a strong bank relationship with somebody that you trust.
Lisa, I think, I'm an investment banker, and you are the first banker that's ever said, I think, to us that your personal finances are really important, especially if you're going out to raise capital. So thank you for that, as well as, the importance of growing at your team. I think the quandary is, if you're a small business, having enough funds to actually pay people, whether they're independent contractors or employees, to build out what you need.
Yeah, and I think sometimes it's a decision, Dianne, between outsourcing and insourcing. You may have to outsource early on, but again, the secret is relationships. If you can form a good relationship with a CPA firm, but a specific person, if you can form a good relationship with an HR firm, but a specific person within that firm, now you're starting to be able to leverage their expertise without necessarily paying for it. If you ask me for advice, I'll give you advice. You may not necessarily have to pay for it. So those relationships are very valuable.
So Beth, we're going to call Lisa.
I know.
Really, Lisa, thank you for that. So if you're looking at, companies and they're stuck or they're not growing fast enough, what are some of the things that a company should be looking at to kind of get things moving?
Well, all companies, I don't think most people realize this, but all companies hit plateaus at various levels of growth. So it may be when you hit 5 to 10 million in revenue. It might be when you hit 50 million. It might be when you hit 100 million, but you're going to do it several times in the life of your company. You're going to hit a plateau. And usually what that means is that you have used up all of the economies of scale that you can within the infrastructure that you have. So basically what that means is you need to now invest in more infrastructure for growth. So you need to invest in people, process, systems, information systems, and assets like equipment if you want to grow to the next level. So you're going to have a lower profit margin for a few years while you're making that investment. But once you make that investment, you'll be able to leap to a whole nother level of growth. And so usually when you plateau, it means that it's time to invest in something that you might have not been investing in to try to save costs. The other thing I will say is there is, especially with women entrepreneurs, for some reason, there's a lack of willingness to use credit responsibly. And there is good credit and there's bad credit. Good credit is when you borrow loans, when you borrow money in order to buy assets that are going to give you a long-term sales advantage. So you do need to borrow in order to make those long-term investments. You shouldn't borrow. Bad credit is when you're borrowing to stay afloat. That's a bad decision. But if you're borrowing in order to grow, that's a good decision. And so you need to differentiate between good credit and bad credit in your head and not consider all credit as bad.
Oh, okay. Yeah, that's very good advice. I'm not credit adverse. Okay. I would imagine as companies grow, just like ours has, C-suite's been in business close to 8 years, that your priorities change. So as the priorities change for these companies, how do they handle the shifts, and what kind of advice would you give them?
Yeah, I think once the company is humming along at a perfect pace, everything's running smoothly, the shift really comes from looking at, you're starting to make, now you're going to have to make strategic decisions about your future. You can't just keep doing the same old and expect, huge growth at the end of the day. You're going to have to make some strategic decisions. And guess what? Strategic decisions come with risk. And everybody hates the word risk, but you need to take risk at some point in your company's life in order to really be successful. So there is calculated risk. There is high percentage odds risk. It doesn't have to be pure risk, but you need to take some risk and be comfortable with that level of risk, knowing that you may need to adapt. It may not be perfect out of the gates, but you're going to have to make some strategic decisions that do require some risk. And you're really going to have to look at two different forms of growth. There's vertical growth, where you're growing a stack, so you're adding products and services that you wouldn't normally do initially. So that would be, let's say you're selling a software product, and you want to add installation, and you want to add maintenance of that software package. So that's like adding products and services essentially to the same customers. Or you want to look at horizontal growth, which is entering new geographic markets. So say you're in Los Angeles and you want to enter Phoenix, Las Vegas, the West Coast, or a industry segment. So say your expertise is, I have a customer whose expertise is transporting liquid items. Well, he discovered that transporting liquid items, he could do that for anything that's liquid. It doesn't have to. He started with chemicals, but then he found out wine is liquid. Wine needs to be transported. He found out, there's certain pharmaceuticals that are liquid that need to be transported. So he went into totally different industries that he wouldn't even have imagined originally, as sort of a form of growth, and has been very successful at all three, because it's really the same expertise that he's applying to different marketplaces in a different way.
That is beautiful.
Oh, wonderful.
So you would consider that to be a calculated risk, where not knowing the industries versus like staying where he was, siloed.
Correct. It's a gamble, but it's really not, because it's building on your expertise. You're already good at it. So you're just applying your knowledge to different things. So it's really not that risky. It is, but it isn't. I mean, your risk is, will the market accept you? That's the biggest risk. Will the market accept you as an expert in that area? So,
right.
Gotcha.
It's the challenge. It's really another sales process, it sounds like, too, right? Because if you're in one vertical and then to move into the next, you have to have an entire sales strategy, marketing strategy to tap into that new place.
Correct. And you have to have a good sales team that can address each market, and it's probably a different sales team that addresses each market, because they're going to have different different contacts, different relationships.
Right. So every company, we all want to sell our company for millions, for sure. So are there any steps that you see that an entrepreneur can take to increase the likelihood of that happening?
Yeah, I would say there's three things that a company needs to do to prepare. First of all, they need to look at a 3 to 5 year horizon. I'm always sad that entrepreneurs hope that someone's just going to walk in the door and hand them a big check. It's not really like that. You actually need to prepare your company in order to sell it if you want to make those big, huge bucks. So I would say you're planning 3 to 5 years to really get ready to get the highest price possible. The first thing you need to do is act as a buyer. You should have everything perfect. You should have all your processes documented. You should have your excellent reporting. You should have excellent financials. You should have their facilities should be pristine and nice and clean. I mean, you should be having everything in your company be as clean as possible. And as a buyer would, if you walk into something organized and clean and beautiful, you want to buy that. So it's the same philosophy. You should be looking at it from their point of view, not from yours. It's your baby. So you have probably rose-colored glasses on. But if you can step back and look at it from their point of view, you might have a little bit better perspective on what they might be buying. Another thing I would say is you absolutely have to reduce all dependence on the owner, which is almost so difficult is that you don't want, it's your baby, you raise this thing, you don't want to let go. Well, guess what? A buyer wants to know that there's an executive management team in place so that when you step away, when they buy you out, this executive management team is still going to be able to keep running the company. So you have to step away and let a management team come in that start to take control of the business, which is probably the worst thing an owner has to struggle with, is watching somebody else manage their business. That's why I say it takes 3 to 5 years to prepare yourself for the transition, because it's not going to be easy. And then finally, you have to maximize profits. I cannot tell you how many companies come to me and say, oh, we've had 500% sales growth, but you didn't grow profitably. And I'm buying based on profit. I'm not buying based on revenue. And that is a concept that some entrepreneurs just don't understand. I'm buying multiples of profit, future profit. I'm not buying multiples of revenue unless you're in some high-tech field where that might be relevant. But typically, it's going to be profit. You have to be a very profitable, maximize the profit of your company, and then you'll buy, the people will buy it for significantly more money than if you are not as profitable.
Well, that's really good advice. So what do you think some of the mental roadblocks are that prevent success? I'm interested in this question.
Yeah, I think there's a lot of mental breakdown of at various stages. I think it changes, right? So I think at first there's maybe a boundary issue between the owner and their personal life and their business. So I think initially there's a boundary issue and they're having trouble balancing the two. And I'm not sure that that's not also the case in a large corporation. If you're responsible for a whole unit, you might also have boundary issues. So I think initially a boundary issue. Then I think you get a little more comfortable with those boundaries. And I think one of the things we see often from smaller companies is that they stick to a partner too long. So they might have loyalty to people who help them get started in the business, but those same people cannot help you grow to $10 million or $100 million. They can't. And so parting ways with people who you feel loyal to is a very painful decision. And unfortunately, it has to be made. Most likely, most companies have to make that decision. It's very painful. And then there's a whole bunch of companies that don't expect growth and they're not prepared for it. So we meet a lot of companies who are growing with their hair on fire, and that's not successful growth because they're not controlled. They lose control because they're growing so successfully that they've lost control of the company. And that's not successful either, because now you don't know if you're growing profitably anymore. I mean, we see this all the time in restaurants, for instance. They open 6 or 7 restaurants at the same time, and they weren't even successful with the first one yet. So let's build a foundation on which to build the second one and the third one and the fourth one, so that you can start repeating some of the successful processes over and over and over again and really start to build synergy. And unfortunately, some people just kind of don't expect the growth, and then they grow with their hair on fire. And that's not really going to help you, especially if you want to sell the company for a huge amount of money down the road.
Oh my gosh, Lisa, so insightful. Thank you for that. So what if you don't own a company, but you're head of a division or a unit in a larger business? Do you think that some of these ideas that you're discussing still apply?
I do. I really feel strongly that even within a large company, there's often silos. And I think sometimes you have to look at the cross-functional processes to really understand where you can really improve your unit. Because if you're just looking at your silo, there could be other silos especially in a large company, that have figured out some of the answers that you're struggling with. So if you don't reach out across the way and build partnerships and relationships across the company, you're going to lose out on some of that knowledge that was gained from other divisions. And other things I would say is that there is a place for calculated risk in a large company, just as much as there is for a small company. I mean, there are times when you can take a calculated risk and try something, just be able to track the success of it, and then be able to adapt and move on and pivot if it didn't work out so well. But if you don't try some things, if you don't risk a little bit, even in a large corporation, you may not be as successful. The company's not going to be as successful overall as if there's some little bit of entrepreneurial spirit in those large companies. It's very helpful to be creative. Sometimes you need to be creative even in a really large company.
Oh my gosh. How do our listeners find you, Lisa? Because honestly, you are such a wealth of information.
I know, it's
How
awesome.
people find you, but you're based in Nevada. So are you looking to grow nationally? Like, can people across the country reach out to you?
Of course, anybody can reach out to me anytime. I'm hoping that, I'm hoping that I'm going to capsulize all this knowledge. It's all sort of wasted knowledge sitting in my head at this point, and I'm hoping that some of these articles, I'm going to start putting them on LinkedIn, I think, and under my name. And I think I'm also going to hopefully start to put them together and publish a book on it. I've been working on that for a year or so, and I'm hoping to sort of capitalize on that. So hopefully eventually you'll start to see me in the public.
We understand how long it takes to write a book.
And of course, you can share those articles with us, and we'll put it in our newsletter that goes out to 25,000 people.
And we repost.
Okay, I will do that.
So if you give it to us, we repost on our LinkedIn's and really make it, broader for you.
I will do that. I'm happy to do that.
Yes. So thank you, Lisa Lobue, who is the Senior Vice President, Business Banking Manager at GBank in Las Vegas, Nevada. And again, how does anybody get in touch with you?
They can reach me via, I would say my personal email, to be quite honest, in case I ever move on from GBank, which is lmlobue@gmail.com. And people can reach out to me anytime. Absolutely.
Terrific. Thank you for that.
And we want to thank our sponsors, ConResnick, City National Bank, Cigna Health, Breakthrough Beverage, Uncle Nearest, and C-Suite Executive Search. If you're hiring for your team, contact us. We have a huge network that we're able to tap into, and we'd love to help you with that. And thank you for listening. And Dianne, you want to wrap us up?
Of course. Please hit the subscribe button, Apple, Spotify, anywhere you find your podcasts. Leave us a review. We appreciate that. It helps the algorithms in some way. And do follow us on social media. That's LinkedIn, Twitter, and Instagram. And we do love hearing from you. Please send Beth an email. Okay. So C as in cat, C-Suite, SWEET.org. And of course, our website is SWEET.org. And we thank you again for listening. Thank you, Lisa.
Thank you, Lisa.
Thank you.